Right now, Warren Buffett's company just poured $7 billion into a stock that another famous investor dumped completely in the same 3 months. Same company, same quarter. One side buying, one side running for the exit. And by the end of this video, you're going to know exactly which one of them got it right, because I'm going to walk you through the real numbers, not just the headline. Stick around, because stock number 4 on this list is down over 50% this year, and I think it might be the single best setup in this entire video. Let's start with that disagreement I mentioned, because it's the biggest story of the quarter. Alphabet, ticker Google, sitting around $345 a share, up roughly 10 to 11% this year, market cap north of $4 trillion. Berkshire Hathaway added something like 48 million shares, worth close to $7 billion at quarter end, and Alphabet is now Berkshire's third biggest position behind only Apple and American Express. Meanwhile, Bill Ackman sold every single share he owned, both classes, gone. Terry Smith cut his stake by 40%. So who's right? Here's my honest read. The business itself is firing on all cylinders, forward revenue growth of about 20%, operating income growing around 25%, earnings expected to climb over 22%. That part's not in question. The problem is what you're paying for it. The stock is trading at roughly 26.5 times forward earnings, well above its own 5-year average of 21 to 22 times. And free cash flow actually fell 51% year over year because of how much they're spending on AI infrastructure. When I run the math myself using a discounted cash flow model, even a generous 14% growth assumption only gets me to around $323 a share, below where it's trading today in basically every scenario I test. So my call is to avoid Alphabet at this price, not because the company is bad, it's one of the best collections of assets on the planet, but because you're being asked to pay a premium with very little room for anything to go wrong. Buffett's team clearly disagrees, and that's fine. They don't need this trade to be cheap to be right long term. But if you're buying today at these levels, understand you're paying up for a great business instead of getting a great deal. Now here's one where I actually think the crowd has it right, and it's rare that 4 completely different money managers agree on anything. Uber, ticker Uber, trading around $76, actually down about 7% this year, even though the business keeps expanding margins and cash flow. Bill Ackman made it his single largest position, adding nearly 15% to his stake. David Tepper added over 20%. Pat Dorsey increased his position by a stunning 61%. And Terry Smith opened a brand new position from scratch. 4 separate people, 4 separate philosophies, all landing on the same stock. Forward revenue growth sits around 15%, operating income growth near 30%, and free cash flow margin expected to grow over 23%. Here's the part that gets me excited, though. Uber trades at only 22 to 23 times forward earnings, a full 25% discount to its own 5-year average of 30 times. Wall Street's average target is right around $102, which is 34% upside from here. And when I stress, test it with a reverse discounted cash flow, meaning I ask what growth rate the current price is. Actually assuming, the answer is basically 0. The market is pricing the stock as if growth stops completely while the actual operating numbers show clear momentum. That gap between the story and the price is exactly what I look for. My call, Uber is a buy, and it's not even close. Let's talk about the stock everyone loves to argue about at dinner parties. Meta platforms, ticker Meta, trading around $590, down about 11% this year. Tepper increased his position by 55%, Dorsey added 24%, Ackman added 20%. Terry Smith went the other way and trimmed 20%, so even here you've got smart money split. The bear case, if you've heard it, is basically that Meta is spending a fortune on AI to protect a story more than an actual competitive edge. I get the skepticism. But look at what's underneath the hood. Forward revenue growth of almost 23%, operating income growth over 21%, and the stock is trading at 19 times forward earnings, cheaper than its own 5-year average of 22 times. That's rare for Meta. Historically, this stock almost never trades at a discount to itself. Analysts see an average target of $750, about 28% upside, and even my own conservative model lands around $734 with every reasonable scenario showing double-digit upside. The real risk isn't the advertising business. That engine is still humming. The risk is timing, whether all this AI infrastructure spending turns into actual earnings on a schedule investors are willing to wait for. If you can stomach a year or two of Meta proving itself, I think this is a buy at today's price. Just know you're funding the bet before you see the payoff. Now, let's get to the one I teased earlier, because this is where it gets spicy. AppLovin, ticker APP, currently around $315, down 53% this year and sitting near 52-week lows. Pat Dorsey added 39% to his position, Terry Smith opened a fresh stake worth about 3% of his whole portfolio. Two respected investors buying into a stock that just got cut in half. On the surface, it still looks pricey on sales, but the forward price to earnings ratio has actually dropped to about 19 times, 38% below its own 5-year average near 31 times. And the growth numbers here are honestly kind of absurd for a company this size. Forward revenue growth of 30%, operating income growth of 48%, earnings per share expected to grow around 65%, and levered free cash flow up 71% year over year. Wall Street's average target sits at $549, 74% upside, and get this, even the most bearish analyst price target on the street is still above where the stock trades today. That tells you sentiment has gotten so beaten down that even the pessimists see a higher price ahead. My own model shows a wide range, from $371 all the way up past $600, which honestly tells you how much uncertainty is priced in here. This is the highest risk, highest reward name on this whole list. One bad earnings report could wreck the thesis fast. So my call is a cautious buy, but size it small. Don't put a big chunk of your portfolio into this one. Treat it more like a lottery ticket with real fundamentals behind it, not a core holding. Quick gut check for you. Drop a comment and tell me, would you rather own AppLovin's upside with the extra risk or take the safer, steadier route? Because our next stock is exactly that safer route, and honestly, it might be my favorite pick in the entire video. Taiwan Semiconductor, ticker TSM, is the toll booth every AI company has to pass through, and the numbers back that up. It's trading around $426, up more than 40% this year, though it has pulled back about 10% from its all-time high, near $480. Tepper added 24% to his position, Terry Smith. Opened a new stake worth 4% of his portfolio, and across the wider universe of major investors, 7 separate managers bought or added to this stock last quarter. The growth story is remarkable. Revenue expected to climb 37%, operating income up around 40 to 49%, earnings per share growth near 46%, numbers that crush the broader semiconductor sector on almost every measure. Here's my honest caution though. The valuation is not cheap relative to its own history anymore. It's trading around 22 times forward earnings, which is basically right in line with its 5-year average, not a discount like Uber or Meta. The average Wall Street target is $547, 28% upside, but the lower end of that target range is just $432, essentially flat from here. And remember, this entire thesis depends on AI infrastructure spending actually turning into sustained profit, plus you're carrying real geopolitical risk given where the company sits. My call on TSM is a buy, but a patient one. This is a name I'd build a position in over time rather than go all in today because the fundamentals are excellent, but the price already reflects a lot of the good news. Now, let's talk about the one nobody's excited to talk about, and that's exactly why I like it. S&P Global, ticker SPGI, trading around $419, down about 20% this year and sitting close to its 52-week low. Bill Ackman opened a brand new position worth over 5% of his portfolio. Pat Dorsey increased his stake by 42%. Chris Hone added to a position that already made up 11% of his fund. And across the broader field, 9 separate high-profile investors bought or added shares last quarter. That kind of agreement doesn't happen often. The forward price to earnings ratio has fallen to about 22 times, way below its 5-year average, near 30 times. And the dividend yield is actually running slightly above its historical norm too. Growth here isn't flashy. Revenue is only expected to grow around 3% near term, earnings closer to 9%. This is not a rocket ship. But here's the number that actually sold me. When I run a reverse discounted cash flow on this stock, meaning I calculate what growth rate the current price is already assuming, the answer comes out to just 5.2%. That is the lowest bar of any stock in this entire video. This company doesn't need a miracle to justify its current price. It just needs to keep doing roughly what it's already doing. Recurring revenue from credit ratings and index products, a beaten down multiple, and a very low hurdle to clear. My call, S&P Global, is a strong buy. And honestly, if I could only own one name from this whole list, this is the one I'd pick because the amount that has to go right for you to make money here is smaller than anywhere else on this page. Let's do one more before we wrap up the individual names. MasterCard, ticker MA, sitting just under $570, basically flat for the year and trading in the upper half of its 52-week range. Bill Ackman and Terry Smith both bought shares, while Chuck Acker actually trimmed his position, though it's still his single largest holding at 20% of his portfolio, so that's more portfolio management than any change of heart. The forward price to earnings ratio sits around 27 times, below its own 5-year average of 31 times. So you're getting a slight discount relative to history, even if it's not screaming cheap in absolute terms. Revenue growth is expected around 14%, with operating income and earnings per share both tracking in a similar range. Nothing explosive, but remarkably consistent, which is exactly what you want from a payments network with this kind of pricing power. Wall Street's average target sits at $665, about 17% upside. My call, MasterCard is a buy, just don't. Expect fireworks. This is the stock you own for steady compounding, not a quick double. Last one, and I saved it for the end because it's genuinely the hardest call to make. Amazon, ticker AMZN, trading around $262, up 14% this year, and 11 different high-profile managers bought or added shares last quarter. Tepper added 16% to his position, while Ackman actually cut his stake by 25%. So even Amazon has disagreement underneath the surface. On earnings, this stock looks like a screaming deal. 21 times forward earnings versus a historical average that's absurdly high because of how the company used to reinvest every dollar back into the business. Revenue growth around 14%, operating income growth near 23%, earnings expected up 24% over the next year. Wall Street's average target of $327 implies about 25% upside. But here's my hesitation, and it's a big one. The entire bull case depends on a massive ramp in free cash flow from around $5 billion next year all the way up past $175 billion by 2030. That is an enormous bet on execution. My low case scenario, using more conservative assumptions, only shows about 3% upside from today's price. So my call on Amazon is neutral, leaning cautious. It's not a stock I'd avoid entirely, but I wouldn't chase it here either. I'd rather wait for either a pullback or actual proof that free cash flow is turning the corner before committing new money. So here's where that leaves us. If I'm ranking these, from best opportunity to most crowded trade, S&P Global sits at the top because it demands the least from the future to work out. Uber is right behind it with 4 separate smart investors agreeing and a valuation that doesn't match the operating momentum. Meta and MasterCard both offer solid, dependable setups at fair prices. AppLovin and TSM are buys too, just sized and timed differently because of the extra risk involved. And Alphabet, despite Berkshire's massive bet, is the one I'd actually stay away from at today's price, simply because you're not getting paid enough for the risk if anything goes wrong. Now I want to hear from you. Which one of these are you actually buying this week, and which one do you think I got wrong? Drop it in the comments, because some of the best calls on this channel have come from arguments people started right there. If this breakdown actually helped you make a decision, do me a favor and share it with someone who's been on the fence about one of these names. It genuinely helps this channel grow. There's another set of moves brewing right now that didn't even make it into this video, names getting quietly accumulated while everyone's distracted by the obvious headlines, and I'm putting that together for next time. So make sure you're subscribed to Tickerhawk, because you don't want to be the last one to find out where the smart money is heading next.